Okay. Welcome, everybody. My name's Pete Rowland, and this is a seminar we're putting on today as part of our financial literacy campaign, which is to help educate people, particularly clients, that it will help them with their financial lives. And we do about three to four of these a year on different topics. And we're open to topics that you have an interest in. So at the end, you can evaluate the seminar, but we also ask for any feedback you have, because if there's enough interest in a particular topic, we'll certainly try to address that. Okay, so I'm going to get started. We're actually, and so I'm talking at this phone right here because there's a microphone, and we have some people who are on this seminar remotely, and so they're listening to us. And it's also being recorded so that other people can view this at their convenience. So what I'm going to talk about today is the new tax law, and I'm going to, first of all, talk generally about how tax planning is such a big part of wealth management. And I'm going to review the new tax law that just recently passed at the end of last year, and then we're going to talk about some planning opportunities that might help you or somebody you know with their wealth. And again, how many of you, is this your first time here? Okay. Well, welcome. This is, so you primarily work with our Souderton office, which is the CPA firm and the payroll firm and our computer solutions business unit. Here, we focus on really two things, well, actually three things. We focus on working with high net worth individuals in our investment advisory area. We work with retirement plans for companies. We'll set those up. And we also work with families and family offices, which is an approach that we look at multiple generations. So it's not just planning for a couple, it's planning for a couple and their parents and their children and maybe their grandchildren. So I want to introduce the members here in this office, and if I'm going to ask you to stand up, and come on, stand up. And so we have Joan Bushman, and Patty Webb, and Chuck Porter, and Brian Burkus, and
Roger's outside the door.
Roger Small is somewhere here. There he is. He's coming in. Anyway, we're here at our Hatfield office, and we focus on these things. If you go over to our CPA firm right now in Souderton, it's probably really, really busy because today is March 15th, and you're all familiar with April 15th when your individual tax returns are due. Well, today, March 15th, is when all the partnerships and LLCs and pass-through entities are due. So they're busy as well. We're a CFEX certified here, which means that we are fiduciaries in what we do, which means legally we have to do the best thing possible for our clients. And beyond that, we even are certified for our practices. So we're very proud of that. We've been doing that for over 10 years. Again, my name is Pete Rowland. I have a lot of experience, I'm old, I guess, but in the area of taxation is where I first started, and I broadened out to more financial and wealth management. So I'll try to inject some of that into this. But this I'm really proud of is I was born in 1960. Anyone else born in 1960? Okay, you don't have to give your age. I just gave my age, I guess, didn't I? Well, in 1960, the highest individual income tax rate was 91%. Okay. And see, what I remember is I came out into this world, And these doctors were all around me, and doctors back then made a lot of money. So they were in a high tax bracket. And they were just complaining about the fact that 91% income tax rate. And then, of course, you had state and local. It's probably like 95% of every dollar they were making was going to the government. And that sounds outrageous, doesn't it? I mean, why would, you might even question, why are you even working if 95 cents of every dollar is going to the government? Not a lot of incentive. That was 1960. But anyway, so imagine the first things I hear is this stuff about the high tax rates. And I think that's what life is all about, is trying to, save taxes for people and help them with their wealth. So I'm kidding a little bit. I don't really remember the first seconds that I came out, but I'm sure it was part of that. Incidentally, my father was a physician, and he was one of the doctors that helped deliver me. So I probably heard it at home growing up, about taxes. And anyway, so that's what I attribute my interest in taxes, is the fact that 1960 was a very high rate. Today's rates seem a lot lower, okay? They're more like 37%, and so forth. At one time, do you know what the highest tax rate was? Do you think it was higher than 91%? Actually, it was 94% in 1944 and 1945, which were the last 2 years of World War II. And the government really needed money to fund the war. And so they took maybe these outrageous measures and taxed at 94% the highest income earners in this country. So, if nothing else, it shows how historically they can change rates any way they want to. And we've been spoiled for quite a few years with relatively low tax rates. Anyway, taxation has a material impact on wealth and building wealth. When you think of taxes and you think of all the taxes you pay income taxes, you pay payroll taxes if you work for Social Security and Medicare, you pay sales tax when you buy something, you pay excise taxes in a lot of the goods and products you buy. And then when you die, there's probably some form of inheritance tax or estate tax. So they really get you coming and going, and taxes for most people is certainly the largest expense you're going to have. So it is really important when we're working with wealth management. We do a lot of investment work here. We do overall wealth management, family office. But this whole area of taxation really is part of everything. So, and that's something that you need to consider. Now, the Internal Revenue Code, I call it a treasure map because some people were afraid of the tax law, but the tax law really gives us a lot of clues, a lot of ways that we can increase our wealth. Why? Because the government wants us to do certain things, and they put into the tax law, what they want us to do. So, for example, they want to help people retire. So they give us these retirement breaks for your company-sponsored retirement plans, 401ks and 403bs, for your IRAs. Why do they do that stuff? It's because they want people to save for retirement or for education. Or here, because we do so much investment work in stocks and equities, the government wants capital to go into the economy. So they give us good tax rates to do that, capital gains rates, which are lower. So all this stuff in here, the Internal Revenue Code, can direct us to, because if you do what they want us to do, you're going to increase your wealth. So let's talk about this new tax act. And it seems like we have a tax act about every other year. Officially, this was the name of the tax act. And I know we're calling it the Tax Cuts and Job Act, because that's what the media calls it. That's what everyone calls it. That's not really the name of it. It's actually an act to provide for reconciliation pursuant to Titles 2 and 4 of the concurrent resolution voted on the budget for fiscal year 2018. That's actually the name of the tax law. And kind of a funny thing, when the Senate went to vote on this, they because the media, the public, it was presented as the Tax Cuts and Job Act, they had to take an extra couple days to change it to the official wording, okay, to prolong it. But the idea, and for the public, is to focus on tax cuts and jobs. Now, and I've been in this tax world for a long time. They keep coming up with these tax bills, and they all have catchy wording, like tax simplification, tax reduction, tax simplification, all the stuff you want to hear. And again, the idea of tax cuts, everybody likes tax cuts, and stimulating jobs, that you know, politically makes a lot of sense. And generally the new rules lower the tax rate, but as we'll see a little bit later, doesn't mean you're going to pay less tax. You have some winners and losers. And again, today we're going to highlight some of those changes, but then also some of the strategies. So what happened is they did lower the tax rates. And if you look at there's single taxpayers, married filing joint taxpayers, if you look at the years 2017 and 18, you can see how the rates have gone. For example, married filing joint, your highest rate before was almost 40%, now it's 37%. Somebody a married couple that has taxable income of, say, $100,000 was paying 25%, now they'll pay 22%. So they did drop the rates. They you know, cut the tax. The other rates that we deal with pertain to capital gains and qualified dividends, which we see a lot here with investments. Again, the government wants us to invest in the economy and companies, and so they give us breaks. And the tax rates are actually lower here. And they didn't touch the actual rates, but what happens is because the brackets now have changed, they're actually giving us more room, more income, that more people can take advantage of these rates. What's really interesting, because a lot of people don't know this, about the zero capital gains tax rate. There's actually, if you have capital gains, if you buy a stock and sell a stock or a mutual fund, and you have a gain, if you're in the lower two tax brackets, you actually pay zero tax. And it's a great opportunity, particularly maybe you're in a high tax bracket, but maybe you have children or grandchildren or relatives who are in low brackets. And it's a great way to you know, sell assets and have gains and pay no tax at all here.
Peter?
Yes.
Are the tax brackets for the gains indexed to inflation?
Yes, they are, and I'll talk about that because that's a kind of a trick, okay, a troop, as I call it. I'm going to teach you a little bit of Pennsylvania Dutch here. Does anybody consider themselves Pennsylvania? Oh, look at that, Pennsylvania Dutch. Good.
Yeah. I was right.
So I'm going to go through, again, going through these changes. Another change is in the standard deductions. Now, when you file your individual tax return, either you take the standard deduction or you itemize your deduction. You come up with your contributions and your interest you pay, the taxes you pay. You add up, you know, you do all that work to come up with the itemized, and you take the better of the two. One of the things they did do was they raised the standard deduction quite a bit. Okay, so for example, this year, 2017, which is what all the accountants are working on right now, the standard deduction was $13,000. It goes up to $24,000, almost doubles. And what that's going to do is it's going to simplify the taxes for a lot of people that won't itemize anymore because they get a high standard deduction. But it also is going to, so the simplification is good, but as you'll see in a minute, is they knock out a lot of deductions, so some people are going to pay more tax. They simplify their tax returns, but they're going to, and I call it a trick, they'll pay more. So when we look at those itemized deductions, and again, you can either take the standard deduction or the itemized, the medical expenses pretty much stay the same. They're 10%, or 7.5% of your adjusted gross income. Anything over that you can deduct. A big change was the deduction for state, local, and real estate taxes. So your state income taxes, your local income taxes, and your real estate taxes. Now you can only deduct up to $10,000 total for those. Okay, so a lot of people that were paying a lot of income tax or have maybe a lot of real estate tax, that is limited. Likewise, the deduction for mortgage interest, they've changed a little bit for very large mortgages. You can't deduct everything. You're limited to $750,000. But another part of the mortgage interest is home equity loans and lines, where before they were always tax deductible. And we would even counsel people. You have personal debt on credit cards. Maybe you should get a home equity loan to pay off the credit cards because the rates are lower. Plus, you can deduct the interest. And so they came out way ahead. Well, now they're going to not let you deduct home equity and lines and loans unless you use the money to improve your residence. So a lot of people that have these home equity loans and lines next year, 2018, which is really this year, they're not going to be able to deduct that. So you see a pattern here is these itemized deductions, they're limiting, okay? Where you used to be able to deduct all this stuff, now you can't. Some other changes, charitable contributions, they sort of left alone, although we can now offset 60% of our adjusted gross income instead of 50%. So that's actually good. We're not allowed to deduct casualty losses anymore. Miscellaneous itemized deductions. So things like unreimbursed employee expenses, investment fees, tax preparation fees, no longer deductible. So all these deductions have now been limited. They lowered the rate, but they're limiting what we can deduct. And finally, the personal exemptions, which apply to everybody, and they were a little over $4,000 per person in 2017, are gone. So if you have 12 children and you used to, be able to get a $50,000 exemption, you're in a different situation. So again, another example of where they lowered the rates, but they took away something. We're talking about children. There are some changes there. The child care credit has been increased from $1,000 to $2,000. So you do get a little more of a credit. They've loosened up, and we sometimes talk about Section 529 plans for education. Loosened up the rules a little bit for that, in that you can use those monies now for kindergarten to 12th grade instead of just college. So that's a little bit better. They've changed the way that young children are taxed, no longer at individual rates, but at higher trust rates. So kitty tax. So there's some changes there. And finally, and these are business related, but they do apply to a lot of individuals. And this is actually a big area of tax planning. They lowered the corporation tax rate to 21%. But they also, as part of that, they looked at the Unincorporated businesses are those businesses that might operate as a partnership or a limited liability company or even as a sole proprietor. And to kind of even things out, they're letting them deduct 20% of their income. Yeah, so after they compute all their net income, they get another 20% deduction. And that's huge for anyone in business. But what's even more extreme is they've expanded, in the last week of this bill, they expanded the definition of a business to real estate. Real estate. So now investment real estate counts as a business that you can, the net income from it, you can exclude or deduct 20% of that. So that's very, very big. You know, you think the president was a real estate person or something, you know, and it just kind of snuck in at the very end.
That's not all business.
There's some, these rules are really complicated, so I'll be glad to talk, because there are some limitations on income. What we're finding is certain businesses they exclude, but you can carve out, for example, a veterinarian. Okay, that business doesn't qualify, but a lot of veterinarians sell all kinds of stuff, like, the bones and the flea and tick, and they make a lot of money off of that. Well, now we can work with them and separate that into a separate entity, and that can be under this. And so we're seeing a lot of businesses that are looking at how they're working, and they might want to operate a little differently. So that's the business. Just a couple other changes. For individuals, we have higher exemptions for the alt-fin tax, alimony. So the rules of divorce have changed a little bit. It used to be that person paying alimony got a deduction, and the person receiving alimony recorded income. And now that's no longer that way for new divorce agreements. So that's impact. Talking about homes, used to be if you sold your home, you could exclude, if you're married, $500,000 of gain. And as long as you lived in that home for 2 out of the prior 5 years. Well, now they've tightened that up a little bit, where it has to be 5 of the prior 8 years. And we used to have some strategies. People with shore properties with a lot of gain, they would live in them for 2 years, make them a resident, and then exclude all the gain. And then they move to their other property and their other property, and they jump around, changing the residency. Now it's a little tougher to do that. And the moving expense is also eliminated as well. 2 changes in the estate and gift tax area. They've raised the federal exemption for estates is now over $11 million, which means a married couple can have over $22 million and leave it free of federal estate tax. You always want to consider estate. A lot of us here, probably most of us here, this federal estate tax doesn't apply because it's $22 million we have to have first. However, in Pennsylvania, we have the inheritance tax. And so there is a lot of tax planning you can do for your estate. The other thing is a higher gift tax exemption. Used to be you could give $14,000 a year to somebody without having to do anything. Now it's $15,000. Over that, you should file a gift tax return, which records that gift. All right, so I said I would teach you a little Pennsylvania Dutch. So, in my evaluation of this tax law, it's kind of a truc, okay? A truc, that's Pennsylvania Dutch for trick. Let me hear you say truc. Okay, good. Wow. I'll tell you, we have a lot of, you might not know it, but we have a lot of Dutchmen and Dutch women in here. So this is a trick. So what they did is they cut the rates, but the rates have gone down, but the actual tax for many people is going up. Okay, imagine that. What a trick. You know, they're telling us your rates went down, and then you're not going to find out till maybe some of you next year when you get your taxes done, and you say, wait a minute, the rates went down, but I'm paying more tax. And it's because primarily they're eliminating a lot of those deductions. It's kind of really tricky how they're telling us we're going to save tax, but not necessarily so. Okay, some people will. You know, the people who really benefit are people who don't earn a lot of money, don't own a house, didn't really itemize deductions before, and now they get a lot higher standard deduction. A lot of the stereotype, maybe a lot of younger people that don't own a home, they're going to be a little better off from this. So there are some winners, but a lot of it is what I call trickery, okay, or truc, being a Pennsylvania Dutch person here. So more truc or tricks in the new tax law is all the benefits they gave us, like the lower tax rates, are temporary, okay, only for about 7 years, okay? And they kept it at 7 years because, now this is how our government works, is you know, what's the purpose of taxation is to raise revenue for their budget. Well, they put this budget up, and they only want to lose $1.5 trillion over the next 10 years, meaning, you know, they want to, that's the, you know, it's high of additional debt that they want from this. So they're producing a budget that's negative $1.5 trillion. Now, those of you who have businesses, are involved in businesses, or your personal, you know, if you had a personal budget with a very large deficit, you probably wouldn't pass it, would you? Okay, but our government can do this kind of stuff. But anyway, that's why it's temporary, because they're giving us some benefits, while at the same time they're taking more from us. But then they're going to let those benefits expire. But they're not going to, what they're taking from us is still there. So in essence, what they're doing is because they're expanding the amount of income they're taxing. But they're not allowing some of those deductions, like you know, the tax deductions, the miscellaneous, all those itemized deductions and exemptions. So again, so now you have more taxable income, which the rates are lower. But what happens when the rates go back up? Well, now the rates are higher, but they're taxing even more of your income. I call it shelf space. They're gaining more of shelf space for you, meaning they're pulling more of your income into what they're taxing. So when they do tax it at a higher rate, they're even getting more. And imagine if they go up to 91% or some ridiculous amount. Well, now, you know, the taxes, and this is where in longer term wealth management, taxes, I think, are a big deal, because we've been dealing with low taxes the last 2 decades. What's going to happen when they do go higher? And I believe they will, because if our government is happy only producing a deficit of $1.5 trillion on their budget, where's that money going to come from? You know, they're going to have to get it from somewhere. And you know where that somewhere is. It's us. So I think as we go forward, taxes are going to even become a more important part of your wealth management. One last little truc, as I call it, is you know, they can change the rules anytime they want. So one of the rules was that there was an inflation factor in things like our tax brackets, because, you know, as you go through life, things cost more and more. You get paid more and more. Hopefully, you know, you at least stay even, but it puts you into higher tax brackets. So they raise the tax brackets, to answer your question, for an inflation factor, but they change their factor they're using now. It used to be the consumer price index, but now it's what's called the chained consumer price index. And what that all really just means is that they're going to raise they're going to say the inflation is lower than other measurements would say, which means over time, those increases probably aren't even going to keep up with inflation. Or over time, it's just kind of a sneaky way or a tricky way to get more of our money over time. So that's another factor in there. All right, so this is, I know, by this point, I've just reviewed some of the changes, and it's a lot. Tax laws, a lot. Famous quote by a guy by the name of Albert Einstein. Hardest thing to understand in the world is the income tax. Okay, so this is not easy stuff, and I don't think they make it easy for a reason here. So let's talk about some planning or some considerations. And I'm going to go through some in a little bit of detail, and I'm going to have a list at the end for other things, because, we have limited time, and some of this stuff is kind of complicated. But I at least want to make you aware of this. So one thing is the W-4 payroll withholding trap. So what they did, and a lot of people, if you work as an employee for somebody, you notice probably in the last month or so, all of a sudden your paycheck's a little more. And you think, this is great, tax cut, okay? And it automatically happened through the withholding tables based on this new tax law. And a trap is this. A trap is for those people who they're going to lose a lot of itemized deductions this year or exemptions. And so they're going to get into this year's tax at the end, and while the rate has gone down, they're going to pay more tax, and yet their W-4s have taken less out of their paycheck for taxes. So it's a trap, and what we recommend is everybody should look at their withholding. Don't just assume that your employer, they're just following the tables like they're supposed to. They don't know your personal situation. And a lot of people are going to get hit with penalties, we think, because they're not aware of this. So that's one thing everybody should look at. There's a strategy for what we call tax arbitrage. So what's going to happen, and this is unique to everybody, is your income's going to go up or down over the next 7 years, let's say. And you're going to be in higher and lower tax brackets, that whenever you can, you want to plan for things to get the most deduction in high tax years and bring in income into the low years to balance it out. And I give an example here of somebody who typically makes a Roth IRA contribution every year. And a Roth IRA is not deductible, but it grows tax-free. We like Roth IRAs quite a bit. But if they, for example, since we know rates are going down this year, 2018 from 2017, right now, because they can put a contribution in for last year up until April 15th, they could put it in a regular IRA, deductible IRA, and take a deduction and instantly convert it to a Roth. And what they've done is they've got a deduction at 28% and income being taxed at 24%. So it's 4%. We call it arbitrage. It's like an instant 4% profit. So that's just an example. There's a lot of other things you can do. You defer a bonus maybe, or you bring it into a year. More than ever, it's important to have a rough idea of your tax bracket so you can make those types of decisions there. Charitable contributions. Now, I mentioned they really didn't change those too much. They raised, you can now deduct up to 60% of your income instead of 50%. But because the standard deduction is higher, and a lot of people won't get any additional benefit from giving charitable contributions. And so there's a strategy called bunching, where if you could bunch all of them in 1 year and not give any the next year, take the standard deduction 1 year, take the itemized deductions another, you could maximize your deduction. The problem is a lot of people don't, it's not comfortable to maybe give to a charity 1 year and then don't give anything for 5 years because the charity needs the money. And a very simple way around that, and these are becoming very popular, are donor-advised funds. So you can make the contribution now and get the deduction when it really helps you, and then maybe the next few years take the standard deduction, but your donor-advised fund can dish out the money when you say to do so. So it's a kind of nifty little thing to maximize the tax benefits of charitable giving. There's nothing more rewarding than creating wealth and giving it away. These are pretty neat. And you know what's neat? I'll tell you something because we have, my wife and I have one, and this is a true story. Not like my birthday. that might have been true. I just don't remember. But she was in a church group, and they were doing sewing and knitting, and just a bunch of ladies. And they wanted to do a project, and the church said there's not money in the budget for it. And it was, I think, only like $200 or $150. And so we had our charitable donor advised fund actually donate the money to be used for that. And all the people in our little group had no idea it was from her because it was from this fund. So you can, this is kind of, you have a lot of fun with these things. And, but more important, or just as important is you can get larger tax deductions, which means you can give more. Another strategy area is what we call the bucket list. How many of you have a bucket list? And this isn't a bucket list, probably that you have. Hey, your bucket list is whatever, taking a trip around the world or doing all these, wild things. And I'm talking about taxes up here, okay? But the three buckets that I'm talking about are buckets of wealth that are taxed now versus buckets that are not taxed now, they're taxed later, and buckets that have wealth in them that are never taxed. And probably the most common area that people are aware of is when you're working with IRAs. Because I just mentioned about, there's deductible IRAs, there's Roth IRAs, maybe you have a 401k plan where you work, and you can have a Roth option or a regular option. You can do these things. And what they're really talking about is how much money, in that case, you want in your regular tax later bucket, where you get a deduction now and it grows and you pay tax on everything coming out, or you never pay tax if it's a Roth. And so if you look at your wealth this way, first of all, determine where is your wealth, in what bucket, and it probably makes good sense to spread it out, because when you get to retirement, for example, and you need money, it's really nice to be able to pick which bucket it comes out of, or mix and match so you can minimize your tax, because whatever comes out of this bucket isn't taxable. Whatever comes out of this bucket is. Whatever comes out of this bucket is probably partially taxable. So if you need $50,000 to live on in a year in retirement, you can pull that out of multiple buckets and keep in a low tax bracket. That's the key, is always keep in the lower tax bracket. Not just 1 year, but hopefully throughout your whole retirement. So it gives you flexibility. And I think with all the changes they're doing, flexibility is going to be really important for everybody's personal wealth going forward. So there's a lot you can do with this kind of strategy, in that you can fill the buckets when, let's say, your income is low this year. Okay? Or remember, in your lives, we have a 7-year window here where rates are going to be probably at least a little lower than any other time in your life. So if you ever thought of maybe converting some of a regular IRA to a Roth, you got to pay tax on that. Well, maybe this is the time to do it. Again, look at your life and look at this strategically on how you want to move your wealth among the different buckets to minimize your tax. So again, there's a lot of Roth IRA opportunities. And all these things, I'm just sort of introducing this stuff. So we'll be glad, any one of us, to talk further about it. It's really hard to talk taxes in a 40-minute seminar here. I can really just introduce things. So, real estate investment. So this is an area, real estate, that all of a sudden I think becomes a little more attractive, at least investment real estate, for two reasons. One is, as I mentioned before, now investment real estate. So if you go out and buy a duplex or a quad, or even if you invest in what's called a REIT, which trades like a stock, which is actually real estate, 20% of their net income is deducted. So it makes it a lot more valuable to you as an investor in investment real estate. Not necessarily your home, but an investment real estate. And the flip of that, the other side of that, is the renters. Well, now all of a sudden, because picture the young person who stretching to buy their first house, and they can do it because they can deduct the mortgage interest and the taxes, so they save a lot. Well, now, because the standard deduction is higher, it probably isn't going to benefit a lot of those people. So it kind of makes owning a little more expensive. Even for everyone else, if you own a home, well, now your real estate taxes and income taxes are limited to $10,000. You can't get that big deduction. Depending how your mortgage debt is structured, you might not get as big of a deduction. Or you might just be taking the standard deduction anyway. So for the renters, it's now, to the owners, it's more expensive. I think you're going to have a lot more people renting instead of owning. The other thing is, seems like demographics is younger people. I have 4 children, so the younger people, they don't want to own. They want their freedom or whatever, and they'll rent and they'll pay high prices for rent. So the combination of stronger demand and better returns, I think, identifies an area that might benefit from this new tax law. Again, you'd think our president was a real estate tax guy or something, right? Anyway, so I'm going to go through a list here, not in a lot of detail, just of other things you can do. First thing is sit down and try to project your income for the next few years and get a feel for your tax bracket. Look at what itemized deductions you might be losing. If it makes sense, try to bunch them. So if you're not going to get benefit from itemizing your deductions, maybe use a strategy for your charitable contributions that I mentioned with the donor-advised funds, where you bunch it all in one year and get a benefit and, come out ahead. You might want to look at your debt. Again, a lot of people, and some of it's our fault here, or the accountant's fault over in Sourton, we would advise clients to take out a home equity loan to pay off debt because the rate's less and it's tax deductible. And it made a lot of sense. Well, now it's not tax deductible in many cases. Okay? Now, rates still may be better, and that's another factor. But you want to kind of reevaluate if you're in that situation. What did I do here, Chuck? What do I click? Remote? So I'll keep talking while we have oh, there we go. That was pretty good. Okay, we're good. Again, as I mentioned, the Roth conversions and contributions, and it may be something you want to do over time because, again, those tax brackets, you want to kind of get almost up to the next one, but not over the next one. So you might need to do things over a couple of years here. Some other general things, IRAs, you want to contribute early, you want to take distributions late in the year. charitable gifting, you want to, when you can, use appreciated assets, because then you get out of paying the tax on those assets. So instead of giving $5,000 to the church, you give $5,000 of stock that you paid $100 for, and you can get rid of all that tax on the gain. Now, is it going to be deductible? It depends on your other itemized deductions. And you might want to, again, use a donor advised fund to give the stock to that, and have the donor advised fund give the money to the church here. If you're over the age of 70 and a half and you have an IRA, you can make contributions to charity directly from your IRA. So it doesn't even flow through all the itemized deduction stuff. It's just a deduction off the top of your income. So that's a good strategy as well. Of course, you want to look at your gains in your investments, and if you can harvest them, especially if you're in the zero tax bracket, or maybe your children or grandchildren or someone you know, again, they can, in essence, permanently avoid tax on those things. You harvest your capital losses to offset your gains. I mean, we do all this here, incidentally. I know some of you are wealth management clients. Some of you are maybe just accounting clients. We do all these things for our clients here as part of our service. Qualified dividends. Dividends from companies are generally taxed at a lower rate. Because, again, the government wants you to invest in companies. And so you might want to, use high-quality dividend-paying stocks instead of, interest income from a bond, which is taxed at a higher rate. And again, looking at some of these other investments affected by the new rules, like real estate investment trusts, because of the 20% exclusion. Education funding, the 529 plans, again, now we can use it for kindergarten to 12th grade. There's a special savers credit for retirement, which now applies to ABLE accounts, which deal with disabled people. And again, just general gifting of appreciated property. Instead of selling something and paying tax on it, maybe you want to give it to your children, and they can sell it at a lower rate. The estates, there's a portability election you can make. Again, I'm starting to lose everyone. I realize that. But I want to at least get them on the list. The 20% deduction for qualified business. So if you're involved with a business, maybe you want to split part of it to make it qualified. Or again, as I mentioned, real estate is now a qualified business. And again, looking at some of the more tax beneficial retirement plans, such as a cash balance plan for your business. So anyway, so that's kind of a summary of some of the things. I'm watching my time. And again, they all fit within your wealth management strategies. We're here to help you with any of this. We're just introducing it today. But just a word of caution about identity theft, because in the tax world, with tax returns and a lot of data, this is a big concern. A lot of people get calls from the IRS. Anyone do that here? I mean, or know somebody who got a call from the IRS? The IRS never calls you, okay? Unless you've already dealt with them and have an agent on a case, they will never, ever call you. They will never, ever email you. So if you get an email or a call and they're pretending, or they say they're the IRS, they're not, okay? And, and this happens all the time. Somebody gets a call and they're screaming at them saying, you're going to go to jail, we're the IRS, unless you bring us a bag of cash and meet us in the parking lot. And people, they get you at the wrong moment. Anyway, just a word about identity theft and fraud. And of course, it also highlights is, where can we find a good shredding truck around here? And one of the reasons we have this kind of event is to help protect everybody and your information, because you can go out there. Not only will it get shredded, but you can watch it get shredded. Okay, right in front of your eyes. It's kind of fun, actually. So, just a word of caution there. Well, at this point, I want to thank everybody for participating in this part of the seminar. Getting Becky in here because we said we would give you prizes, at least some prizes here. But again, to kind of recap things is the new tax law, the importance of tax planning in your wealth management plan, because it's such a big factor, and it's only going to be getting bigger. You need time?
2 minutes.
You have 2 minutes. Okay. Did everybody sign the sheet? Because Becky's going to give you some. She's only going to pick, I think 3 of you that you get the prize. And I apologize to the people remotely. If you really want to, you can email us, and we'll get you in some kind of special drawing here. They're not real extravagant prizes. At this point, again, Becky will come back and do that. Are there any questions or comments about anything?
Yeah, I have a question. On this charitable contributions, if you have an IRA, say you get $1,000 from the IRA, if you give $800 that to a charitable organization, is that included as income then or not?
No, it's not included in it. So, and in effect, then, the alternative would be it could give you $800, you pay tax on it, you turn around and give $800 to the charity, and it might not be deductible because of your itemized deductions or your bracket, where to guarantee it's deductible is you can have it directly go to the charity. Again, once you're 70 and a half, and but it's a great strategy for anybody, that's of that age to get the benefit of charitable contributions.
And it counts towards your required minimum distribution as well.
Sure.
So it counts towards your required minimum. So if you take 5,000 and you take 1,000, it reduces that 5,000 to 4,000 at least. Okay. So it can be pretty advantageous.
Oh.
So I see Becky is ready. So you're better at this than me.
I'm ready to get. I'm going to just pick one. And this will be for travel month.
Travel month. These are collector's items.
I'll be right back. I need to know if I have underneath my sheet.
Any other questions? Yeah.
Is this presentation available for review afterwards?
Chuck does the magic here. He's getting this remote so people can hear us from wherever they are.
Yep.
But also it's being recorded. So there will be a link on our website, and you can watch this over and over again.
The first number was picked was 13, and that was Marlon Hartman. All right. And that would be a travel mug. I guess, right? Yeah. Thank you.
Another question.
Any other questions?
I have 2 actually. Not to sound, I don't want to politicize this at all, but the Democratic narrative seems to be that this tax cut is designed for the rich. But what I'm seeing is anybody earning less than 100,000 back of the envelope, and less than 100, but less than 500,000 is 100,000 benefit, and anything greater than that.
Yeah, it depends. Okay, it depends on their situation. Again, if they had high itemized deductions before or no itemized deductions, it redistributes some things. And just from my observation, it redistributes them. It seems like more among the middle class people. It redistributes them. The very poor still really won't pay much in the way of tax, and the rich get away.
Where do the rich benefit?
Well, things like I mentioned the real estate, okay, and 20% of their income is now not taxable. If I go buy a property, I got to borrow the money, and so I probably don't have a lot of taxable income from the property. But if I'm really rich, I pay cash for it, and I have a lot of income from the property, and now 20% of that, forgiven. The other thing is look at the estate tax. So now, and I guess it depends on what you define as rich, but now a couple with $22 million doesn't have to pay any federal estate tax if they do things right. And that's doubled from just under this law.
President Trump is talking about a phase 2. Any insight what that may bring?
I don't know, because, it's funny because we've been following this tax bill that they just passed for about a year, and it makes all kinds of changes, and then at the last minute there's extra changes. So I think a lot of this stuff is political. I mean, again, the name of the act, it was framed the Tax Cut and Jobs Act, what everybody wanted to hear. And so they are talking about more changes. But let me tell you, they have more changes. There's some winners, there's some losers. This change they just made, they're still projecting a $1.5 trillion shortfall. And somewhere down the road, we're going to have to pay for this. So I have to think that over the long run, the government's going to have to get more money from us to do all this.
Second number was picked was number 7, and that's Dave Strauss. And a travel mug.
Thank you.
Any other questions? And again, we're here. This is what we do. And so talk to any of the advisors. And when we're managing your investment accounts, but we also are bringing in this kind of knowledge so you get more out of that.
Okay.
You're the prize giver.
The third number was picked was number 17, and that was Leon Bechtel. And
Right.
Leon, this is a coin.
Very good.
Great.
Oh, very nice.
Okay. I think with that we have refreshments. Stick around and linger as long as you want. Remember, we got the truck out there. So if you haven't shredded anything and still want to shred things, and even if you didn't bring anything, I'm sure we can give you some stuff to shred. I mean, you just sat through a tax seminar, so we probably all feel like we want to go out there and shred some things, right? So again, thank you very much. And please fill out the sheets for evaluation and give us any suggestions you have of topics of interest that we can help you with.
Those are very helpful.
Good. Thank you.
Very
Thank
good.
you.
Very good.
Yeah, thank you.
Thank you. So who's